SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Pascal Wagner, founder of Grow Your Cash Flow and general investment strategy consultant across a variety of asset classes. So Pascal, thank you so much for joining me.
Yeah, excited to be here. Thanks for having me on, Sean.
Why don't you give folks a high-level overview of yourself and grow your cash flow and everything that you're up to?
Okay, yeah. So I am primarily an LP investor myself, and I've had a lot of experience working in venture capital and had to, help my mom with the transition into developing passive income. It kind of started with, in 2018, I sold a company and I started working for a venture capital firm called Techstars. They're one of the top 3 accelerators in the world. They invest in over 300 companies a year. And I got to sit on the investment team and really learn how institutions invest. So they raised a $150 million fund and they put together the investment thesis. And then it was my job to sit down and figure out which of the companies within the existing Techstars portfolio we would follow on into. And so a lot of that defines kind of how I invest today. And while I was there in 2021, my dad had passed away from old age and, left my mom a couple $1,000,000, but no real plan or real way to make that money last. And so that became my new job in figuring out, okay, I worked in venture capital. I understand how investing and funds work. I also have been in real estate for the last decade. I own a single family portfolio in Atlanta that I rent by the room. I have 11 homes, 94 units. And so after my dad passed away, first thing I did was reach out to a bunch of different financial advisors, and they said, hey, we stick your money in the market or in these types of funds. And having your money in the market isn't a way of developing cash flow that my mom could live off of. And so it became kind of my goal to figure out, how do I help my mom build over $100,000 a year portfolio so that she could, as a 65-year-old retiree, continue to stay retired and sail off into the sunset and not have money be a factor. And so reached out to a bunch of different groups, went to a ton of different conferences, probably spent over 50 grand in doing all that in my education, and learned from people in this mastermind group called GoBundance, people who are actually living off of their investments, and uh, learned, where are they investing, what are they looking for. Now $3.5 million later in over 23 different investments across self-storage, oil and gas, multifamily apartment buildings, retail development. I've done pretty much quite a few different asset classes. And at the beginning, whenever you get into alternative investments, you don't really know what you don't know. Now that I've done quite a few of these, I've also applied a lot of what I've learned at Techstars, and I've used that to now successfully help my mom build that $100,000 a year portfolio. So through that process, I just realized there's no one that teaches you how to be an LP investor, how to put together a strategy, what are all the different funds you invest into. And that's what led to starting Grow Your Cash Flow, where, if you're interested in cash flowing investments, which is how we got connected, I have a weekly deal flow. I click on every ad. I join as many different operator newsletters as I can. I'm in different mastermind groups. I take all of that deal flow, put it into a database, and I share all the newest deals every Friday with the investors on my list. And people then usually ask, hey, how do I pick between all of these? I have a program where I coach LPs on how to kind of put together a plan and a strategy, apply that to the deal flow that I provide them, and then give them different framework to vet these operators and help them pick the best ones for them. And so that's what I do today at Grow Your Cash Flow, and I'm excited to be here and dig in a little bit more.
Very neat. Well, thanks for that background. I think the whole concept of the weekly deal flow, that's obviously something that we're very big on as well, even though we focus on a pretty sub niche of a lot of what I think you're looking at a little more broadly. But because you have such a eagle's eye view into all these different deals and different asset classes, it'd be great to get a sense of some of the patterns and some of the strategies you pursue that tend to be true across all these asset classes, right? You've said, you've done a handful of deals now, you've learned quite a bit. What are kind of the common themes you're starting to see?
Yeah, so I think looking at over 2,000 deals at Techstars, buying a bunch of my own real estate, investing in a bunch of these different LP deals and asset classes, and then also just coaching people who come through my mentorship programs. One of the key things I find where people struggle the most is they get a deal in their inbox and they start to try and dig into the investment, and in the back of their mind they're asking themselves, like, how do I know this is a good deal? How do I make sure that how do I vet the operator? Like, maybe they're even trying to look at pro formas and financials and get in the weeds, and maybe they don't even really know what they're looking at, but they like the opportunity, it's interesting, and what they're doing is they're starting with the deal first. And what I found is that regardless of what you are investing into as an LP investor, most LP investors don't have a grand or macro plan. Where I'm focusing is, hey, if you're looking to build $100,000 in consistent monthly passive income so that you can leave your job, for example, or just have the option to, we are starting with a macro plan that might take 10 or 20 investments at what check size into what sectors. Like, let's build a macro plan and then work backwards from that. Okay, now we've decided that we're looking for a certain amount of cash flow. Okay, let's look at our first investment. What is the lockup period we're willing to tolerate? What kind of redemption period? Do we want to be in equity or do we want to be in debt because we want to be a little bit more conservative or safer with the investments that we're making? Do we want to work with an early stage emerging manager, someone who maybe has 20 million or less in assets under management? Or are we trying to go after an institution that has over $1 billion in management? And so, ones with audited financials or unaudited financials. And so it's really taking a step back and understanding what are the parameters for the next investment I am going to make out of a broader plan towards a goal, whether that's growing your cash flow to 100K a year or you're trying to 2x your portfolio in the next 5 years, right? And it's really starting there at the top. And then once you have that kind of filter in place, that filters out a ton of deals. And then, we could continue going down the rabbit hole, but the next item is then how do you validate that the operator that you are looking at or the deal that you're looking at is worth it, which would be the next stage.
Yeah, that's a really good point. A lot of folks we talk to are excited about small business acquisitions and want to invest in small businesses, but there's plenty of folks that haven't thought about that kind of high level portfolio approach, right? And even above that, to your point, kind of taking what your wealth manager or someone similar might say, what are your goals, right? And when a wealth manager asks you that question, a lot of folks will say, oh, I want to get 8% a year. I want to get this or that. I mean, the wealth managers usually start with, do you have your insurance in place, right? They start with like, build the foundation, the classic kind of pyramid, right? And then get your safe bets and your safe kind of capital preservation strategies. And then you've got kind of your alternative stuff. But I love that you've kind of taken concepts of that and have really applied it to this alternative space. What are your goals for your alternatives portfolio, right? Is it cash flow? Is it generating a multiple on your portfolio? What do you find that folks most frequently come to you with? I assume it's probably a cash flow strategy given the name.
Yeah, I mean, everything I've been doing has been focused on cash flow. I do have quite a few people that come in through my door that make several $100,000 a year, business owners, like commission sales reps, and for them, a lot of what they're they have cash flow. They have a ton of cash flow coming in, but they're still interested in understanding, like, are there investments I can make that can lower the amount of taxes I pay each year? And so there are all different kinds of unique asset classes and strategies that can help an investor based on what their needs are.
Yep. Yeah, and we're starting to see more of that. We in the small business acquisition space, we sort of have two approaches from a cash flow standpoint. You've got we're always doing equity deals, but you've got the deals that will distribute cash, kick out a distribution or a dividend year over year, and then you've got kind of your longer term compounding strategies that have a cash flow profile almost more similar to a venture investment in many ways. But what's, I would say talked about a bit less, but starting to get a little more publicity are the tax advantage strategies like qualified small business stock. I just spoke with a tax planning gentleman who went really deep on this, and some of that has changed now with the new tax bill. And then there's also, in your world, it's probably a lot more acute, but the bonus depreciation changes and all that can really have pretty significant impacts for folks from a cash flow and from a ultimate return perspective.
Yeah, I mean, I think the one big beautiful bill, love it or hate it, for an investor, if you are investing in this space, it's done a lot to incentivize more capital to flow through alternative investments. Make opportunity zones a permanent thing. And bring back bonus depreciation so that investors are more incentivized to deploy capital into our communities and put America first. Major improvements in all those areas, which help both of the niches that we're in.
Yeah, lots of scrambling on deal structures. That's for sure.
Yeah.
To make sure that the benefits are being maximized. So what you've got kind of focus on cash flow for the most part. You've done a handful of different asset classes within real estate and then also within debt. It sounds like you've done some equity deals, but maybe, how just a little about how your approach differs for each of these strategies, asset classes, whatever you want to call them, right? How do you look at when you get a real estate deal, you add it to your deal sheet, or you look at it personally? How does that differ from when you get an interesting private credit fund or something of that nature?
So the way I approach it and the way that I coach and give a system to the people that come through my door, I really try to make it as similar as possible. And, I think the first thing, we just talked about, the first part of the equation is really just sitting back and figuring out what are your goals, what is your plan, what does the treasure map look like, where are you trying to go, and what do we think the steps are along the way, and those steps may change. But it's really more about it being consistent. So a lot of people focus a lot on the interdynamics of a deal, the pro forma, and if there's anything we know, the pro forma is always wrong. We've said this when I worked in venture capital. That's the number one thing we would say. It's like, we need the business to be a $1 billion business potential, but we know that the financials are going to be wrong. So what are the things that we can look at to make sure that we have the best possible chance of this being a home run? And so whether that's in debt funds or in an equity deal or in venture capital, it's really the same when you're investing with someone else. After you've decided, is this aligned with my plan? It's, okay, this operator, they've done multifamily real estate apartment buildings. And, is this their first apartment building? Is it their fifth, but they haven't had any deal go full cycle? Have they had 10 deals go full cycle? Okay, so what I'm focused on is, let's look at the deals and how they performed, and do they match the same strategy that I'm investing in now? And, like, past performance is not a predictor of future success, but they are highly correlated in my eyes. And so understanding how transparent are they? If I'm investing in a debt fund, I am looking for a loan tape. I'm looking for, here are the 100 loans within the fund. What are their interest rates? When did they start? When are they going to end? Do they have that information? Are they willingly providing it to the investors? If not, then I'm not interested. If I'm talking to a self-storage or a mobile home park or an apartment building syndicator, then I'm looking for all of their historical deals and the deals they currently have under management. How are those performing? How did the ones that went full cycle go? Okay, the ones that went full cycle, were they all in the last decade where you didn't even really need to execute your business plan? You benefited from the interest rates lowering and
Right.
and people being willing to spend more for a property? Or did they actually execute their business plan as well? And so really just looking at those pieces without even really getting into the deal will tell you more about an operator and their strategy and how consistent they are, which I argue is the most important piece out of all of it. if you're doing a deal and you've already done 10 other deals like it, and 18 out of the 20 went well, and you are willing to sit down and tell me, oh, these 2 deals didn't go well, and here's what we learned, and we've tightened up our criteria since then, and since then we haven't had that issue, then the micro dynamics of the new deal that you're looking into, I think, matter significantly less, because what you're doing is investing in the operator and the way that they approach things, and you're investing their trajectory.
That's something that we talk about so much in the small business acquisition space, because you're ultimately backing a jockey. I think you've called out a handful of, call it signals, right, that can indicate whether someone's gonna have a positive outcome or an outcome that's kind of on track with the underwritten plan. And a lot of those signals, like past track record, experience within a specific asset class or industry for us, or type of deal, all these things are very similar to what we look at, right? So the underwriting approaches, even though the asset classes might be a good bit different, the importance of backing the right person and the right operator continues to be a common thread pretty much across all investment opportunities, I think, right? So,
Something that I learned, maybe I'll share a story of why I think that is actually the better place to focus as an investor, and maybe pull in experts on maybe the individual deal dynamics. I have a story at Techstars where, as part of my experience being the follow-on fund manager, I got to travel around to all this, I think, 70 different accelerators that Techstars has. So, think 12 companies come into an office for 3 months, they get mentored. And as part of the screening process for a company to get into the program, the managing director of that program will interview 30 companies, and the managing director will bring in maybe 7 to 10 colleagues, mentors, experts in the niche that they're in. So let's say there's a payments accelerator, and so you might bring a CEO of a bank in, and you might bring like a product manager at a Visa or MasterCard. And so all of these people are sitting in the room, and the managing director is leveraging the expertise of the people in the room to really understand this entrepreneur who's pitching this new model. Of course, I, as the managing director, don't have the insane super detail on what maybe this entrepreneur is doing. But what I can do is pull a bunch of different people who are very well versed in the space and have them share with me and the rest of the group, who are also experts in that niche, why they think a model is great or won't work. And so that managing director can more focus on the operator parts that we talked about, the track record, what is their experience, what is their growth rate, things like that, and then pull in the experts to really hone in on the specifics of what they're working on. And I think that it works the same way. I think if you're an LP investor, you should be thinking about it the same way. Your job is to figure out, high level, does this fit in my plan? Does the operator look like they know what they're doing and they're executing the same strategy they have multiple times with success? And then, okay, they're doing this specific deal in Nashville, Tennessee. Can I go find an apartment, syndicator or other people that I know that have maybe invested in that market, and have them look at the deal because they know the most about that local area? I think that's one of the better ways to approach it. That's at least how I approach it now after doing this for so long.
yeah, it's a good way to do it when you can kind of bring in experts to provide an opinion and kind of improve your diligence, because you're never going to be able to uncover every stone, and you're never going to be able to get up to speed the same way an expert is if they've been doing it for, and put in their 10,000 hours, right? So it makes a ton of sense. Then your expertise comes down to the lowest common denominator, which is picking the right people to back, right? So that's great, and I think a really good strategy. I guess to that point, what are some common or frequent red flags that either the experts uncover or that you uncover? You talked about kind of lack of transparency, maybe a lack of track record, things like that, that are maybe unique to your approach or that are just more broadly across a lot of the folks you work with? What are red flags that continue to come up?
Yeah, look, so I'll give you an example from a student who brought me a deal 2 weeks ago. What's thrown around in this space a lot is this concept of like, do your due diligence and look at the operator's track record. And that can mean a lot of different things. So 2 weeks ago, the student brought me a deal, and this deal for an operator that she was looking at, they did shopping centers. When you look at their track record slide that shows the 20 past shopping centers that they've done over the last 10 years, it shows that maybe like 90% of those deals were buy and hold deals. And they had maybe an average of a 28% IRR. And then 10% of their deals were development deals. And those didn't do so well. And they had an average of like a 14% IRR. And when you look at this whole track record sheet, okay, you're saying on the whole, they perform really well. Most of their deals perform really well. And then this student comes to me and they're like, hey, check this out. Yeah, their track record looks good. And then I look at the same document and I see, okay, you're missing the picture here. What we care about is what is their track record in the exact strategy that you are investing in. And the deal that she was looking at was a development deal. And so to me, the track record of all of the other deals that had a higher IRR are actually completely irrelevant. We just want to look at the track record of those previous development deals, because that's a buy and hold strategy is very different than a development strategy. And it's nuances like that that I find that LPs miss when they're looking at deals.
That's a great example and some really, I think, tangible takeaways for folks, right? If you're talking to a sponsor, a searcher, or a syndicator, or an operator, and really anyone bringing an investment opportunity to the table, ask the question, have you performed on in the same industry or in the same asset class, right? Because we do see folks that come into the small business acquisition space and they're touting track records in startup entrepreneurship or startup investing, which has similarities. There's adjacencies for sure. There's, just like we're talking about on this call, overlapping concepts and skill sets, but it's not the exact same. There's going to be different, as you put it earlier, kind of, micro or idiosyncratic kind of nuances about the new strategy, right? That are not going to be just bases that this operator has covered in the past, right? They're going to be new learnings. And I had a gentleman I worked for a few careers ago who said, I don't want anybody to be learning on my dime, which I think is a good concept that investors should take to heart. If it's a brand new asset class, a brand new strategy, there's a chance that person's learning on your dime, right?
I mean, you're finding this a lot in the last 5 years, I think, of commercial real estate, is that, there are people that have been doing apartment buildings for the last 10 years. And then all of a sudden they're starting up a debt fund or they're going into self-storage. And then it's like, look at our track record. We've done so well in commercial real estate, but you're really entering an entirely new asset class. There's new nuances. You're probably dealing with different zoning laws. Everything is different. And I see that a lot. And I think that's something that LPs need to be wary of.
Now, to be fair, there's lots of emerging managers out there. We're an emerging manager, right? So we can't go too deep into saying, it's all about track record's the only thing. Of course, some investors will invest that way, especially institutions. So maybe how do you kind of, deal with when you see an emerging manager who maybe has a few deals under their belt, but can't definitively say, hey, I have a 10 deal track record and I've brought you a 25% IRR for the past 4 years. Then how do you kind of change the way you look at it?
Yeah, look, I think there's pros and cons to different parts, right? So if you are investing with an institutional manager, so I'll just use Grant Cardone. I think he's maybe a finfluencer that maybe many people can relate to. Grant Cardone is an incredible operator. Love him or hate him, if you don't, like what he does online, his team can perform. And I know because I've looked at their track record from their real estate deals. And when you invest with Grant Cardone, he does not have the best terms for you as an LP. He basically promises like a 6 or 7% cash return and then, like a 15% IRR. And his deals as an LP have largely performed that way. And he's able to take a much larger cut from the GP split because he's been doing it for so long. He's got a huge team. He has a big track record. And so you as an LP maybe get the safety of working with someone who has been doing it for a long time, but also the trade-off is that you don't get as crazy of returns. And if you flip that, if you're working with an emerging manager, for them, it's much more difficult to get capital under their belt and to build that track record. And so what you find is that many earlier stage, I guess, fund managers are willing to give significantly higher splits and don't take as many fees and have a lot more of their own money in the deals. And so by working with an emerging manager, they don't have as much experience under their belt, but if and when the deal goes well, that you get a much larger percentage of that action. And so it's really about figuring out where you are, right? I find that when you are earlier on in your journey, either you're making your first couple investments as an LP or you're just younger, you're willing to take that kind of risk. And I find that when you are older, or at least the clients I work with, where they're in their 60s, they can't lose the money. And so for them, they need to work with institutional managers. And so I don't think there is a right or wrong, but I do think there is it's not even I think, I see the differences of where people invest based on what their priorities are.
Yeah. And to your point, if you went to an LP and said, hey, you can invest in a deal Grant Cardone is doing, get a 20% IRR with, the same fee structure as an emerging manager who's offering the same thing, 10 times out of 10, you're going to go with Grant because they've got the team, they've got the experience. So you need to see something that says, hey, if you go with the emerging manager, there's a slightly higher likelihood that it may not go well, but your return, if it does go well, is going to be 3 times more. And
there's also differences in the way that the types of deals that these people can pursue too, right? So like, for example, a Grant Cardone needs to buy $100 million, $500 million buildings. And the amount of, all the institutions who need to place a large amount of money are fighting to place the huge amounts of capital they have. They just can't simply invest in the smaller deals because they have too much capital to deploy. Whereas an emerging manager, they can't raise, $100 million to buy a $500 million apartment building. And so they need to raise $1 million and buy a $5 million apartment building. And there isn't as much capital fighting for those types of deals. And so there is a lot more alpha or, return to be made in the bottom of the market, I guess I'd say, right? That's why you hear about all of these strategies where, people might be just rolling up small businesses and packaging it up so that they can turn around and sell it to an institution who's willing to pay a lot of money for someone to just do that work of aggregate. These are all strategies, and you won't be able to work with an institution that focuses on the small end like that. It's just due to the amount of capital that they need to deploy.
Yeah, I had a conversation with the independent sponsor we backed. This was probably 3 or 4 months ago. And we're just talking about our fund and our strategy, which is obviously very similar to what you just kind of laid out, right? And the way I described it was there's a lot of emerging managers, whether it's in our asset class of small business acquisitions or real estate or private debt, that are operating in this end of the market that is inherently capital constrained, right? You need to do just as much or almost as much diligence on these small business acquisitions as you do on a business that has, 10 million EBITDA. It's not the delta isn't so great that it's just easy to do these deals, right? You still need to spend money on lawyers and on accountants and a lot of times on third-party experts, like you've said, and you've got to do the whole business diligence work yourself. So it's capital constrained because once you do all that, similar amount of work to the larger deals, but then you end up writing a $500K or $1 million check. And the more experienced folks aren't even going to bat an eye at that. They want to increase their AUM. They want to be writing $10 million checks or more. So it's actually quite a benefit for some of the emerging folks because it's a way to get in without needing to butt heads with these much larger institutions. And it's really attractive for passive investors, LPs, because you kind of have to go to emerging folk, to your point, to get access to these, really niche ends of the market where they're capital constrained. So I think that's a really good point on why somebody might want to go with an emerging manager. I don't know why anyone would.
You've
But,
nailed it.
Great. We're coming up on time here. I'd say any kind of final stories you'd like to share?
No, I would probably just say, like, look, if you're looking for deal flow, real estate or cash flow oriented deals, then I have a freebie. Like I mentioned, I have at least 25 deals in this thing I call the Passive Investing Starter Kit, and I update that every single Friday if you're on our list. And we have deals like the one that Sean has in that list. If that's interesting to you, you can go to passiveinvestingstarterkit.com. My main platform of choice is LinkedIn. So if you like the show and you'd like to chat more, reach out to me there, and would love to connect.
Thanks so much, Pascal. It was great chatting with you.
Thanks for having me on the show, Sean.